While banking marketing often presents financial crime defense as a sleek, automated AI dashboard, the operational reality is a web of over 2,000 annual compliance filings and 500 distinct legal obligations. The execution layer of this global defense rests in Global Capability Centers, or GCCs. These operational factories are concentrated in offshore talent hubs, such as Hyderabad and Mumbai, far from a bank's nominal corporate headquarters. A GCC differs from traditional outsourcing in its ownership structure. It is a fully owned subsidiary rather than a third-party vendor contract. By owning these centers, banks maintain direct data sovereignty and keep institutional knowledge in-house. This ensures that the patterns identified by risk models compound inside the organization rather than being lost when a vendor agreement expires. Understanding modern banking risk requires mapping the exact mechanics of this compliance factory, from initial customer onboarding to final regulatory reporting. Global compliance at this massive scale involves integrating AI virtual employees into a vast, physically distributed human operation. Customer due diligence serves as the foundational legal barrier, intended to identify and verify every individual before they can move money through the system. This verification process increasingly relies on the Video Customer Identification Process, or VCIP. During VCIP, the system captures more than video. It logs metadata like live GPS and date timestamps to verify physical location. Virtual employees run first-pass checks for facial spoofing, separating authentic biometrics from deepfakes. Flagged anomalies route directly to a named human analyst for manual review. While standard accounts follow basic due diligence, high-risk playouts, like foreign entities or politically exposed persons, trigger enhanced due diligence, requiring analysts to investigate the source of funds and ultimate beneficial ownership. Once an identity is legally confirmed, the Global Capability Center's focus immediately shifts from initial verification to continuous, real-time transaction surveillance. AI provides the processing scale required for millions of daily onboarding. Post-onboarding, every active account is fed into a continuous transaction monitoring engine. This engine monitors for two distinct categories of crime: money laundering, which involves concealing large-scale criminal proceeds, and counter-terrorist financing, which often targets much smaller, legitimately obtained sums. This workflow diagram shows the volume management strategy. First-tier scanning is handled by AI virtual employees, sitting directly above a specialized group of human approvers. These virtual employees scan millions of daily wire transfers, including bundled batch transfers, against intersecting logic gates representing specific risk parameters. The system isolates transactions deviating from a customer's baseline, like sudden spikes in velocity or unjustified routing complexity. When the system flags an alert, it packages the transaction with its full audit history and routes it to the human execution layer. Analysts in the GCC focus their attention on these specific exceptions and anomalies already identified by the AI's first-pass monitoring. This triage ensures that human expertise is applied only to genuine, mathematically confirmed threats within the massive volume of global finance. Confirming a threat within the Indian GCC triggers a legal escalation framework mandated by the Reserve Bank of India and the Prevention of Money Laundering Act. The bank must then generate a Suspicious Transaction Report, or STR, for submission to the Financial Intelligence Unit. Regulatory timelines are rigid. An STR must be filed within exactly 7 days of concluding that a transaction is suspicious. This chart maps the necessary chain of custody. The system links each STR to a named human approver and appends an immutable timestamp to document compliance with filing deadlines. This level of documentation is critical during audits. Banks are held directly responsible for their controls. Shifting accountability to an external vendor is not an acceptable response for regulators. These standards also apply to international agencies. The Office of the Comptroller of the Currency holds global banks liable for actions taken within offshore entities. To satisfy these examiners, GCCSs must enforce SOX-aligned governance, which includes a strict segregation of duties between those who investigate alerts and those who approve filings. Effective regulatory defense depends on an unbroken, auditable chain of custody that a fully owned entity is designed to provide. Beyond monitoring individual transactions, the GCC aggregates data to meet global macroeconomic and tax requirements. This includes executing U.S. tax compliance through the Foreign Account Tax Compliance Act, or FATCA. This matrix shows FATCA's operational scale. The GCC processes self-certifications to determine tax residency, sorting them into reporting buckets for U.S. taxpayers versus the rest of the world. For U.S.-linked accounts, Rules 114F, G, and H govern the IRS reporting requirements. Simultaneously, the Center executes massive data engineering tasks for global capital adequacy, including Dodd-Frank stress tests and Basel III-IV calculations. Sustaining accurate, large-scale compliance is a prerequisite for a bank's continued access to U.S. liquidity and the global financial markets. The GCC functions as the technical engine that keeps a financial institution legally solvent across multiple jurisdictions. AI and virtual employees compress high-volume, pattern-based work so human experts can focus their time on the highest-risk adjudications. This model allows institutions to manage thousands of annual filings under a unified, SOX-aligned governance framework. Building these capabilities inside an owned entity generates a compounding return, as process knowledge and risk model refinements remain within the bank's own infrastructure. Financial institutions that utilize GCCs maintain direct governance over their risk models and the underlying data sovereignty. In an environment of constant regulatory expansion, the operational layer functions as the primary defense against systemic and regulatory failure.